Malinaw ba? Who doesn't speak Tagalog here? I'm asking, baka mamaya I might be speaking two languages already. Oh, si BJ. I'll try my best. Okay. Um, Wait, I have to share my screen pala. Sorry. Yeah, okay. So let's begin. Uh, First of all, thank you for inviting me, giving me the opportunity to pay it forward and share with you guys what I learned the past decades of trading. Thank you to Cloud Arc, Sheena, and especially to Chairman, uh, the the father of financial literacy in the Philippines, at least in my eyes, or the champion of stock market literacy. So for giving me the opportunity to help in participating in this legacy of empowering through the stock market. So I really enjoy also, like the chairman, teaching the kids. I always remember when I was starting. So I would say you guys are lucky because there are really no channels for us back then to learn these things. So if only we could have learned this earlier on. I think the chairman in his introduction to this internship already said what were our experiences back then, mga wild west namin dati. So if you talk about risk management, that's really not the main focal point of our trading back then. It was all about psychology and lakas ng loob. So today, what you will learn today is actually something that, as I've said a while ago, it's not. I'm actually the last person to be qualified to teach this. I think the best teacher of this lesson is actually the market. So for those who have started trading, I think if you experience losing, especially in the beginning, I think those are valuable lessons that you should be able to keep in mind. So today, the title of the lecture is Foundational Risk Management for Trading. So this is mainly focused for trading and not investing. Maybe investors can learn a little, can take something out of this. And it's foundational because it's the hardest place that you can rely on as you go through your trading career. So as you see in the picture, what I showed here, supposed to be rare black swans, but in this day and age, especially in the with the interconnectedness of the world, um, black swans are not as rare anymore. So it becomes really important to have this risk management as your tool. So there. So I assume most of you are just maybe a year or two trading, uh, doing that, practicing trading, trading their own money in the at least in the Philippines. So I assume that you are experiencing one, two, three, and one, two, three, and maybe four. Because when I started, we went straight to four and five. Eh. Counting one, tas diretso four and five because it was the bull market then. So as I always share with others, I think it's the worst time to be born as a trader only because you will build the bad habits. Um, Siyempre, Superman ka agad. So, the foundation is really not that solid, as they say. So until the market turned over and we experienced this period of no interest, I think it was mentioned also in the introduction in this internship. So that's the worst time that you will experience. So there you will experience those big drawdowns. So in general, as a beginning trader, this is common because theoretically you'll be trading randomly from tips, um, random sizing, especially, diba? From tips. If everyone's buying it, syempre buying dito, diba? All in na agad. So really there's really no process in the beginning. So it's more of action without thinking, as the chairman would say. So action without thinking, big drawdowns, small losses that compound, small losses put together become big losses also. So at least in this lesson, you will learn to remove one and two, which I think is a big improvement already. Don't think about four and five, but after this you have to focus on one and two. At least on the one and two, removing that big drawdowns and small losses. So, so at least in my experience, there are three paths to drawdowns. One is, well, you have an excuse when it's unexpected. Let's say sumabog tsunami that happened in Japan that dropped a Tokyo Electric to be down 50% in a day, diba? So at those instances you have an excuse. But there are drawdowns that are caused by, for example, consecutive losses, string of losses like 10 straight losses. Those are normal occurrences for a trader, especially when you're starting. And then you experience sometimes the mother of all losses, which we say, if you don't cut your losses, you will experience the mother of all losses, which is a very, very big loss that will cause your drawdown. So, especially on the consecutive losses, you have to be able to survive this period. So, in a way, risk management will help you go through that go through that period if ever that happens to you. Um, Essentially, probably the most important again, Enrique, I think uh, in his intro told that this probably is the most important lesson that any any aspiring trader will learn early on. Maybe the past 4 weeks of lessons you might forget, but this one, at least if you can take this to heart, this afternoon to heart, at least this will be a this will give you a big improvement in your contribute to a big improvement in your trading. So essentially, when you're trading, you'll experience four types of outcomes, one of which, again, is something that you should be able to learn how to remove. I also saw in your introduction um, phases of a trader. I think that's At one point, you'll become a boom bust trader, zero sum trader, because a big part of it is not being able to remove that big loss. So again, this is something that I will be going through at the beginning, just telling you stories about and concepts about risk management, and later I will tell you about some important formulas that you can use. So today, that's the afternoon. Appreciate. Hopefully, you can appreciate risk management for especially for your trading business. Um, it's actually simple. You just have to learn that one simple formula, and that's a good start for any trader, which we call the learning how to compute the value at risk or position sizing. And some concepts like foundational concepts like constant betting, or what you call yeah, position sizing, and base counting, and then a little bit of analytics that you can use for your so you can keep track of your trading and learn how to evaluate each trade that you will make. So yeah, that would be the afternoon for today. So let's begin. So this is anyone knows this guy? Kilala niyo ba to? So this is Dr. Robert Frey. Dr. Robert Frey has a PhD in, he's a data scientist, and he used to be the partner of Renaissance Technologies, partner of Jim Simons in the Rentec Fund. So him with his theories and with his machines, with his servers, he made a study of the stock market of for the last 180 years. It has existed. Um, so what he found out, is this. He found out that 75% of the time, the stock market is in a state of regret. Uh, if you look at the graph, the shaded portions, those are the states of regret. So that's happening to us, to investors, 75% of the time. So state of regret meaning, sayang hindi ko nabenta sa taas. Uh, so, well, no one can sell at the top, di ba? Pero I think that's the experience of the market 75% of the time. And within that 75% of the time, 60% of the time in that 75%, the trader or the investor experiences an extreme drawdown of 20%. So you can see how really just difficult this market is. So it's really, what's the point of doing it? It's really difficult. 60% of the time within that 75% of being in a state of regret, you experience 20% drawdown. So you see how difficult this market is. It's confirmed how difficult it is, and you can just imagine. You can just imagine how the outperformers are able to do it. So being the 5% out of the 100% that, diba, 95, they say 95% of traders fail, and this is probably the main reason that it happens. So not being able to sell at the top, and usually new traders or new players come in at the top. So you can just imagine how many players experience that state of regret. throughout this period. And even experts like Steve Cohen, he recognizes the difficulty of the market, and for him, three major causes of drawdowns are liquidity, leverage, and concentration. So you can just use this, uh, shall we say, you're standing on the shoulders of giants, and even them, they know the difficulty that they see in the market. So just put this in your, you know, just trying to be conscious of these concepts will be a big help for us to, you know, to manage our trading. And you can't blame those new us traders and investors, because there are classic sayings like put all eggs in one basket. Can anyone complete this saying? Who can complete this saying? Put all good eggs in one basket. Sino ba? Sino ba may alam nito? So the complete quote is put all good eggs in one basket and watch that basket carefully. So by Carnegie. So that's the concept that if you're really skillful in one thing, you just have to focus all your funds in that thing, like this tightrope walker on the left, diba? I know that the probability of this person falling is very high, but if the skill is really pretty high also, I think the risk offsets is being offset by the skill. So so it's really hard to bet on the person that's really skillful in that way, diba? But maybe it can maybe makakalusot yan at with that kind of condition. But if you look at the picture on the right, sometimes the lining between being too smart and being too stupid is really hindi mo it's really silver lining is really thin eh. So you really can't sometimes recognize it. So sometimes there are concepts that are really stupid, like the one on the right, diba? And this is what we call you're too skillful, and sometimes you will fall at the hands of hubris. Eh. So so at that point you'll be thinking about doing stupid stuff like this. So we are prone to those things sometimes, diba? So black swans are not that rare anymore. So sometimes if you experience you make money at one point, then suddenly the market turns over, which is really common nowadays. The one on the upper right, that's the Tokyo Electric collapsing suddenly. So those things are possible. Manila Water, as simple as Manila Water, solid company suddenly falling 20% in 5 days. Those are some of the black swans that happen. And especially in Hong Kong, those type of moves like the one on the lower left are common. And recently on the upper left, that's Mark Cuban right there. Even a billionaire like him falls prey to those happenings. I can give you a lot of. I asked some of our Hong Kong traders some examples of it, and there are a lot in Hong Kong. So it really pays to protect yourself just to see this, just by knowing these things, by being aware of these things. There's really no excuse of not protecting yourself. Now, the reason why we're yeah, that's the reason why I'm pushing hard on this point, how difficult this market is and how common are these black swans are, is because losses have a psychological negative psychological effect on traders. And as simple as more than the material losses, the most important loss is the psychological loss, meaning losing your confidence eventually. Aside from money, you lose time, and you experience that what we showed a while ago, the concept of period of state of regret. So imagine this chart, this Amazon. You're somebody who doesn't know risk management, being able to buy Amazon at $100 during the tech bubble. It really takes a lot of time. Really took a lot of time for Amazon to recover. And you can just imagine people being experiencing that period of having their positions draw down by 98%. It's easy to say that, yeah, hawakan ko na lang for 10 years. But, you know, easier said than done. And through that, I could just imagine through that period, as always, regrets. It's either you freeze or you do stupid things. Eh. That's how regret affects a person or investor. So if it's all the money that you have and you plow it into Amazon, believing its story, and then suddenly it crashes down on you. So aside from the money and time that you lose, the confidence of still playing the market, di ba, can push you to quit, eh, which is the largest, I think, the biggest loss of all. When you suddenly just try not to figure it out and just quit altogether. That's why there's really big effort to really avoid these drawdowns. Yeah, part of this effort is also because you don't want to experience this Sisyphus. If you guys are familiar with this myth, King Sisyphus of Corinth in I think it's a Greek mythology to eh. So basically, this king. So the story says uh, Sisyphus fooled Zeus twice. Parang he escaped death twice by fooling the gods. So on the third try, medyo nakahalata na si Hades, the god of the underworld. So he cursed Sisyphus to he gave him eternal life, but he cursed him by having him push a big boulder over over ano, over a mountain. So si Sisyphus will have to carry this boulder on top of the mountain. And what will Hades do is, if he's close to the mountain peak, he will Hades will bring this rock back to the bottom. So Sisyphus will keep on repeating and repeating this process. So you can just imagine this madness that is madness that is that Sisyphus experiences. Uh, I think the best term I read the best term that this perfectly describes this. It says here, he cursed Sisyphus to an eternity of useless efforts and unending frustration. So so it's a really nice way of not nice, but it's really a perfect way of describing um, when you experience drawdowns and when you keep on digging a hole, it's really difficult to recover. And sometimes you experience that an endless uh, repeating of failures. So if you look at this table, if you dig a hole of 50% drawdown, you'll need to make 100% on that same portfolio. What's left to be able to recover? And we for and to tell you frankly, I've experienced this for a lot for how many times? How many times? That's why it's really something that hits close to home, and I want to share with you so that you will not be will be aware of it. Try to avoid experiencing it. So rather than wasting your time pushing that boulder on top of the mountain all the time, di ba? You don't need to experience the drawdowns already. But I have to warn you, even if I say this, most traders would know that if you're not careful, sometimes really again the market is the best teacher, and sometimes you can't avoid but really learning from the market, even after me telling you this. So hopefully this is something that sticks already. So there's a reason why you really have to avoid the drawdowns. And if you look at this chart of the Nasdaq index against your equity curve, and we've been always telling traders to be always keeping their equity curves in mind against the market. So meaning what you want, the equity curve that you want is something that doesn't follow the market, especially when it's going down. If you look at that line on the upper right towards the end, the outperforming trader will be avoiding these drawdowns, big drawdowns. So there's a reason why the two quotes that I placed here, maybe some can complete it. So one is a quote by Edsay Cota and the other one by George Soros. So there's a reason why these quotes are exist. So the first one is the elements of good trading are what? Anyone can answer that? Can complete that quote? The elements of good trading are what? Cutting losses, and cutting losses. This is by Ed Seikot. And the other one is, it's not whether you're right or wrong, that's important. So this is by George Soros. What's important is how much you make when you're right and how less you lose how less that you lose when you lose. Diba? So, there's a reason why these two statements are two statements exist. Is for you to make a lot when things are great, and for you to lose a little when things are going down the drain. So yeah, I think this is something that we should be aware of if we learn risk management and just internalize it against our equity curve, against our trading business. So another concept is this power of always compounding. So comparing different types of market participants, so investors probably, this is a probably a poor example, but you get the point. Investors, most of them follow the market. So if you compound it, think about the power of compounding things on a year-to-year basis, and adding them all up in the end, you'll see that the trader, even though how small the compounding return is at the third year, the trader still ends up with the most total compounded return. And for hedge funds that are aggressive, like John Paulson, the second row, you see that those small numbers there, the negative 36%, negative 17, negative 52. Those are John Paulson, the Advantage Fund who shorted the subprime crisis. So he made a lot in the shorting the market during the time, but so he was able to compound his account from 300 million in 2003 to 38 billion in 2011 until he loses 52% when he reached 38 billion. So what's the point of compounding everything at that one when you're at your biggest, you lose the most of it. So really the effort is really it's he's still ahead if you think about it, but in the end he also quit. Nag-quit siya recently lang, mga 3 years ago. 3, 4 years ago. So this made him quit also. He couldn't get his groove back after losing that much. So it's really, so the point is, no matter how small your compounding is, just as long as you avoid losing, it's all well and good. So the point is, try to survive, keep on surviving until you get that kind of market that fits you. So lost in understanding of what it is to be managing funds is the concept of long-run distribution of outcomes. So if you see here, the table here is a sample of how we track our results in CTS. So we have that all of our trades are classified into groups of returns. So if you look at it, basically most of the return of this trader is a loss of actually negative 25% to 0%. So he's around that. This guy is basically probably a break even to a small loss trader. He hasn't reached that. He couldn't get that 1%, 2%, 3% return on the trade. So this is how we track this, evaluate our returns. So the concept of long-term distribution of outcomes is basically saying that your trading business is actually the aggregate outcomes of all of your trades. So it's a multiple number of trades, and also you'll be doing multiple number of trades, and also per trade you have to track how much you make against how much you lose. So that's your edge. So the concept of multiple number of trades is really sometimes new traders couldn't understand and really couldn't really there's a deeper understanding of it if you really try to think about it. Multiple number of trades means that you have to be able to make those trades, which means that you have to survive. So iba yung starting your career and then trade all in ka sa isa, then you're out. So the concept of having a sustainable business is to realize that you have to make those multiple number of trades, meaning somehow you have to understand that you have to survive to make those trades so that you'll have the opportunity to take on those very good reward to risk trades, which will compound your edge. So understand that. So before I go into the formulas, a little differentiation of investors against traders. So basically for an investor, basically both of them, the concept is high risk means high reward. So for Warren Buffett, for an investor, his favorite holding period is forever because the longer he holds, the higher the reward that he's expected to get. So high risk, high reward. So meaning the longer you are exposed to the market, the longer you have that position, you have that open position, the higher the probability you are exposed to unnecessary risk and also to surprising rewards. So for us, our system requires us to be risk first and profit second. So if a trader is systematically allocating his investments across issues that he will hold for the long run, so that's why the EIP works, the Easy Investment Program works because you're doing it periodically, not all in one go. So somehow you're reducing the risk of your holding period because you're getting into the market slowly. So the difference is that's an investor is allocating across issues, but on the other hand, the trader is systematically allocating across setups. Because setups, as I will explain later, have that um, advantage of timely reward to risk opportunities in the short run. So the trader will be focused in the short run, taking advantage of that timely reward, good risk reward, usually at least 2 is to 1, at least 3 is to 1 opportunities in the short run. So meaning by using setups, the trader is being risk first because he's removing that, sorry. Ah, so because, again, the trader is being risk first because he's removing that unnecessary risk that the investor has, which is the open position risk. Never mind the opportunity losses, diba? That comes with holding it for a longer time. But he's timely entering in the market. Not always being in the market all the time, but timely entering the market. So he is essentially protecting capital first, and at the same time generates return in a timely manner. So if you talk about capital efficiency, I think this is an ideal approach for short-term trading. So again, by using setups, there's no probability of blowing up, meaning ubusin niyo yung account nyo in one go. There is capital efficiency because you are timely entering the market, good risk reward profiles, and then at the very least you have that 3D approach of trading setups, meaning if you can try to focus on the high quality setups, high quality companies with setups, then that's the most ideal. So the principles, any questions wala before I proceed? So no questions. Any questions? Wala. So let's continue. So the principles that we will learn this afternoon is the principle of position sizing, wherein I will teach you the constant betting formula or the VAR based formula, and then the base counting principle, wherein we will regulate our position sizing as we advance bases from base 0 to the topping phase, as I will show you later. So before we proceed, so I have to show you these two pictures of two traders. One is trader Eddie, who manages risk well by avoiding big losses but also giving up the large gains. So it's okay, just as long as he avoids big losses. He keeps losses small, tries to let profits run. But his hit ratio is only 30%. Whereas the other one is a more aggressive one. Si Trader Jack, stubborn guy, stubborn with fundamental views. He has big winners, but alongside big winners are some trades that go bad as well. But his hit ratio is 60%. So if you look at their performance on the left, I'm making this up as I go along. So, so just trying to explain my point. So if you look at the returns of Trader Eddie, 30% hit ratio ended up positively, but Jack, despite having a 60% hit ratio and all those big returns like the first three ones, he also has these big losses. So in the end, he ends up having a loss. So sometimes the problem with this one, you will only be if you don't, especially if you don't evaluate yourself and write down your results. Sometimes you will only remember the big returns that you made. So what if Trader Jack attends Kalum, 'di ba? So the good thing about attending Kalum or learning about risk management is you'll learn about position sizing, learning to standardize your risk taking, and trying to limit your losses to a certain range. So rather than losing 18% as he did a while ago, diba? What if he only tries to limit those losses to at most 1%? That alone, that adjustment alone gives him a result that's really far from what he used to have. So you can see here 59%, whereas previously a negative 7%. So that simple adjustment alone will does a lot to someone's portfolio. So going to the concept of position sizing, which Trader Jack, Kalum Jack did. So the concept of position sizing is really simple. So the objective of this is trying to optimize your returns, not maximize it. Um, you'll be what you'll do is if these pies are your portfolios, you have to divide it into equal sizes. So that's position sizing. Whether it's 1/8 of the whole portfolio or 1/16 of the whole portfolio. But the concept is every time you trade, you risk the same amount. So I think this is easy to grasp. And again, the goal of this is to optimize your returns and not maximize it. So, which means if you have 100,000 account and your VAR, so if your VAR is 1% or 1% of the total account, then For you to blow up your account, you need 100 trade losing streak to finish all of your 100,000. And the probability of that is very to happen is very small unless you're really adamant on losing every trade again. So again, giving that high quality to each and every trade, a 3D, a 3D systemic process of trading having your trades, qualifying your trades, making it high quality per trade will really increase your probability of compounding returns. So position sizing. Um, so it's very simple. If you have $100,000 account and your VAR is 1%, then your VAR is on a dollar basis is $1,000. So you'll be risking $1,000 per trade. So that's 100,000 times 1%. So that's 1,000. I think that's everyone, any, all of you can compute that. So now the idea is to be able to compute the number of shares once you have decided on that VAR, whether it's 0.5%, whether it's 2%. So the next step is to be able to compute the number of shares that you will trade. So to compute for that, first you have to know where you will enter, and you will have to know where your protective stop is, meaning your cut loss price. So that will be entry price minus protected stop. That will be your denominator, and your numerator will be your VAR. So in this case, $1,000 over entry price minus protected stop. So I think all of us can compute this. Interactive ba tayo? Can anyone answer the first one? Or I have to answer it also? So wait, hold on. It's difficult for me to, if no one's talking back. Anyway, so I guess you can answer this. Okay, may sumasagot sa chat. Sorry ah. So the first one. Sorry. Okay. So Tristan, the first one is, tama ba? 200. So that would be $50,000 times 2%, which is $1,000 divided by $5. So $5 meaning $75 minus 70. So that's $1,000 divided by 5. 200 shares, correct? And Alvin said for the second one, that's, yeah, 0.5% VAR is $500 divided by 20 cents. 20 cents because $20 minus 1980. Correct. Correct also. 25. Russell and Alvin. Thank you. Sorry, this is something really new to me. Dinosaur na eh. Do you need to pause o tuloy na lang tayo? How about this one? Who can answer this? Who can help me answer this? Let's say you have 3 prospects for the night. Who can answer the first one? A Crocs trade. The portfolio is the same, 100,000. So $100,000 portfolio. 150 shares. So that would be 1,000 divided by 108.68 minus 102.18. So 1,000 divided by 6.5. Oh, correct, correct. Okay. How about the second one, the previa? So what's the answer on the second one? So rounded up, 325. Correct. The, the third one, correct. Okay. Correct. That's 331 shares. So that's basically our job. That's basically the job of a trader. So you try to find these ideas and try to approach it in this manner. Trying to decide how many percent VAR you will risk and trying to compute how many shares you will enter. So that's basically majority of the trading management that a trader does. So for example, today you have these stocks. Just giving you a glimpse of how we do things. For example, today you have this stock, diba? 4 stocks for tonight. So I computed the number of shares already. So tell me the exposures naman and the total exposure and the total VAR that you are expected to carry the carry concurrently the whole night. So correct. Just add simple. Just add the VARs. So the 4 stocks will be carrying 2.75% VAR total. That means if you put your stops pre-market and all of them gets done, you will be carrying 2.75 VAR. for the day. Meaning, if you get done and nakat kayo, hit all your protective stops, you know what the amount that you will lose. That's 2.75%. Correct, correct. How about the exposures? Total exposure. So in the end, what would be the total exposure? Do you guys know how to compute the exposure? So that's the number of shares, the number of shares times the entry price. So how much of your portfolio is exposed, meaning open. So for example, the first stock, KOOK, the exposure there is 500 times 50, which is 25,000. Okay. And so on and so forth. So if you compute it, what would be the total? So for RM, that would be 100 shares times 71. That's 7,000. Yeah. The third one is, okay, tama, Jethro. The total is 54,100. So you'll be exposing 54,100 of your $100,000 portfolio. So for those who aren't able to get it, just multiply the entry times the number of shares, and you get the amount. Then add it all up. Add the four exposures together, and you will get that total exposure, potential exposure for the day. So this is your plan. You're willing to risk 2.75% VAR for the day if everything gets done. And with that, you are exposing 54,100 of your exposure. Your risk is not the total exposure. You're not risking that 54,100. What you're risking is the VAR. Okay. So, the difference. So sometimes you will see, most of the time you will see traders like me using leverage, because sometimes the VAR or the the entry and the stop is the difference between the entry and the stop is very small, causing the number of shares to be very big. So sometimes when the are very big, shares times the entry, sometimes you have to use leverage to be able to trade. So this is what we do. Every day we decide if we can take this kind of risk. For tonight, for example, will I be able to take this 2.75 VAR risk with this kind of market? Is the market sentiment really calling for that 4% risk? Maybe uh, I can say to yourself, maybe you can add more risk. Sometimes when you have a carryover position the previous day, let's say you have, let's say you were able to sell half and carry overnight the other half of your previous day's position. Sometimes you can consider that a VAR risk of zero, especially if you have sold half already. Meaning you're thinking of breaking even with the other half. So that's why the VAR is zero. So a few betting nuances. So sometimes, so what we did a while ago, the very basic concept was the constant betting. So equal betting for every trade idea that you want to trade. So that would be static, meaning if you want to trade 1% for every trade that you make, that's what you call static. The other one is academic, meaning there is a little bit of adjustment depending on the quality of the setup for you. For example, doing my analytics, I like the reset setups, for example. My hit ratio using the reset setups is, for example, very high, especially in this kind of market, 50%, 60%, for example. And I saw reset setups, and my standard risk for reset, for example, is 2%. But because of that data information, I might add a few, a little bit more. For example, 3%, for example. So this is a higher level form of sizing that you can, depending on your experiences or your expertise, especially if you're somebody who's really good at, for example, analyzing growth companies, and you are an expert, for example, in the semiconductor sector, and probably you've called something similar years ago. So you see this, for example, pullback setup that in normal normal trades you usually risk 0.5%, for example, diba? And because you're an expert in that field, you add a little. So you're treating not all setups or trades as having the same quality, because this is important, because if you're a very active trader, and sometimes it can be detrimental to a very, the thin line between over trading and expressing your edge, diba? Sometimes it's very fine, so blurred. So most of the time, if you're somebody who's prioritizing charting, minsan pare-pareho na lang yung setups eh. So wala kang differentiation on every setup in terms of the kind of quality of the company that you're buying. So if it's something that you really know, especially favorite mo yung company, and you see a setup that you want to trade, and a setup forms with that favorite stock of yours, then you will, sometimes you have to add a little bit of risk just to be able to differentiate it from your other usual trades. So for example, you have three setups that you want to trade, and because of your after evaluating your trades, you saw that your A trades, you're confident with trading coils, diba? Then what you do is try to, rather than 1% risk, 1% risk, let's say alam mo yung company, you make it to 2%, or try to adjust the exposure, rather than 20%, going on 25%, adjust a little. So you're adjusting your exposure based on your confidence of the trade. If you're not confident, say momentum trades, medyo bulok ka, di ba? Try to lower your VAR, your risk on it. So you're adjusting your risk based on how confident you are with the setup. Sometimes you have to adjust it based on the liquidity of, let's say, the stock. Babawasan mo, let's say, medyo illiquid tong stock na to, try to reduce the exposure. So those are some of the betting risks. So in the end, what you will be having is a range of outcomes in terms of the losses side. So, your VAR side, di ba? Mangyayari niyan, you'll be tolerable into risking from negative 1 -1% to around zero. So, not necessarily a fixed amount of, let's say, 0.5, 0.25, but you'll be um, moving in that range in terms of risk. So not as static and not as constant as, or not as robotic as the 1%, just 1% in constant betting for, let's say, 1% in one trade, but you're trying to adjust it based on your qualification of the setup. So quickly lang, just to see if you understand the concept. So what type of betting do you recommend for, number one, for Vico? She's a newbie. Static, academic, anyone can answer? Okay, static, why? All in. Put more VAR for, aggressive to see Alvin. Why static? I just want to see how if you guys get the concept. Yeah, that's basically it. Yeah, try again. Drawdowns can be created by consecutive losses, so it helps that you have a smaller VAR in the beginning to be able to allow you to make those multiple, as we said a while ago, multiple trades without losing too much. Try to, so you're be in a period of discovery, so try to lose a less, lose, lose less. Try to be consistent with things. Exactly, Eric. Still doesn't know what setup he's good at. Or she still doesn't know what setup she's good at. Vico. So number two, it is a very strong market and stocks are flying. After evaluating his trades, Isco found out that based on data during such market conditions, his trading accuracy on momentum setups rise to 60%. So medyo may konting, what does he have? What did he discover? What did he discover? Alvin. Okay. Okay, okay. So why academic, Alvin? What did he discover? Essentially, what did Isco discover? Yeah. What do you call that term? Okay. So Alvin said for number two, it has to be academic because from history and numbers, he has been successful. So specializes in momentum trades, Adrian said. Yeah, correct answers. So basically what he discovered was an edge already. So this is something that you want to discover and try to capitalize on. So in terms of capital efficiency, that's one step, meaning it's not random anymore. So in CTS, we're putting a lot of effort in trying to discover our own A trades. Spend a lot of hours of coaching to be able to find these A trades. So number three, Sarah is a techie and had made several accurate trading calls in the technology sector. She recently found a stock that has similar qualities and elements compared to the past calls she made. So number three, who can academic also. So Sarah's an edge in terms of analyzing tech companies in the tech sector. So basically that's that again. This is what we do in CTS. So after learning almost everything, you try to lessen, weed out things that you don't need, and try to focus on your strengths. This is really betting. This betting nuance academic is actually betting on your strength, essentially. So not really far out from your constant betting of usually the standard kasi is 1% risk per trade. Maybe you can go 2% or 3, but really not far from what what the normal standard that we risk in each setup. So just in a way trying to put that extra on your strength, on your edge. So as you know, so at this point you know already how we do. You have a glimpse of how we do things. Basically, it's like a music producer that you have a lot of these switches that you try to regulate especially when you're managing a trade. When markets are bad, you try to lower the volume, lower the risk that you're taking, di ba? When things are doing well and you're a winning streak, sometimes you try to increase your risk taking a little, just trying to be loosen up a bit on your risk taking, di ba? Or when you're blowing cold or experiencing losing streaks, you try to lower it. So if you're trying to mix mix what mix in real time whatever you're experiencing in the market, aside from the plan that you make pre-market, on real time you're trying to balance between risk taking and gunning for your potential rewards. So everything, all of these, diba, you're trying to capitalize on whatever you can control. All the switches that you can control. That's basically the point of of uh, this lecture at this point. So all these concepts in the next few concepts will also add to these switches, as you say. So the next, any questions? Later lang, no? So the next concept will be the base counting principle. So the first principle was the position sizing, which is easy. You just use the var, compute the var. It's very easy. You can go static or you can go at academic, depending on your confidence. The next concept is base counting. So basically, base counting is the first. I think the belief in base counting is rooted in that price advances are moving in bases. So meaning the farther it is from the advancing phase, where the advancing phase began, as you go far from where the move started, the insight is that the risk is potentially higher. So through the advancing phase, I think this was taught to you. from neglect to advancing to topping, you regulate your exposure. So that insight alone um, points to a um, you lowering your risk as it moves, as the advance or price advance ages. So here's the base counting framework. So this is ideal if you look at the drawing on the right. So the framework is that price advances move and begin from the neglect or base area, base zero, and as it breaks out and breaks its previous high, it creates a base, a faster duration, faster than the neglect, syempre, whether it's a reset or a duration, but ideally a coil, a shorter one, then the next base, and then the topping. So the neglect, what follows the neglect phase as the trend is ongoing are shorter durations like coils and blue skies until it reaches a very volatile topping environment. So as you go along, so the value of this framework is as you move along this framework, as you move along the bases, you regulate your risk. So you lower your exposure. So let's explain that. So basically, base counting is also parallel with the pyramid principle, wherein you put in more when at lower bases, then you lower your risk taking at higher bases. I think this is easy to understand. So you're actually, as I say, pyramiding going up. Siningit ko lang to. So the logo reminds me of a pyramid. So it's good to be reminded of the pyramid because of the logo. So again, with that concept, base counting and pyramiding, again, you try to imagine your equity curve as you go along the bases. So as you reach the topping phase, your equity curve should be flattening at the very least. As things become volatile, the more your equity curve should be avoiding it and quieting down. So why is it more risky? Why is it riskier when things are peaking, diba? At the top, when things are topping? So when things are in neglect or in reset, you have what you have there again are strong hands. So the hit ratio is very low because there's really no timing, and really there is not much participants that are actually not much traders when things are in neglect or below, shall we say, below 200K. But the rewards are very great. So it's a low hit ratio, high risk reward ratio area when things are in neglect. So mostly the insiders are participating there. So they're putting their money not because they're timing it, but more of they're seeing the value in those companies. So they can sit on it until it becomes correct. So they're practically strong hands that can hold for longer. But at the when things are frothy and things are peaking, at the top you will see a lot of participants. Beyond bases 1, 2, maybe 3, bases 4, it intersects with the topping phase. Um, a lot of participants, a lot of traders, diba? Traders who trade using setups, timing, a lot of timers in the market. So the hit ratio is high, but the risk reward is very, very poor. So so when things are topping, the black swans are plenty, are common. So why are the black swans common? Because from the bottom to the top, there are a lot of profit to be made, and it's really prone to profit taking. So it's like pushing on a string where it's really it takes really a no, a big balloon, di ba? Overinflated balloon that it only takes a small prick to a small needle to prick to pop the balloon. Di ba? And it's so easy to cause a correction. So at this point, you'll be um, it's an overcrowded trade wherein traders or participants are looking for any reason to sell the market. That's why black swans are common. And when they sell and profit take, they can sell up to the lower area and still again, as they say, break even. So the risk is really high when you're at the top. That's why the concept of pyramiding or base counting works. So our sweet spot as traders is in the middle. Not too much participants. Timing is yeah, at least 50-50, 60-40, diba? Not much surprises, minimal black swans as activity is starting to increase. And also this concept, um, we always talk about mutual funds wherein they expose themselves in a big way when things are frothy. You can't blame them because by law they are required to deploy 90% of their AUM all the time. So meaning retail players or investors will give their money to fund managers when things are frothy. So the natural tendency for asset allocation is really an inverted pyramid. But when you're a professional, you know that black swans appear at the top and white swans at the bottom. So you should be more aggressive when things are not frothy, at least in terms of size. So with this concept, we offer. This is just a suggestion, so you can make your own percentages. So basically, at the bottom, you can try to scale up to maximum of 100%. So meaning scale up because setups kasi don't appear at the same time. So usually when things are basing at the neglect period, sometimes the leaders come up first. So you can start beginning with those scaling your exposure, aggressiveness with those leaders. And then as the advancing phase is ongoing, as it goes to base one, since you're fully deployed at the bottom, you try to scale out to 80, or if you just arrived and saw this So the base one, you can maybe regulate your exposure up to 80% until you reach the topping phase. So at that point you'll be scaling out close to 0%. So this is just a suggestion, you can make your own. But the concept is clear that you have to be heavier near the resets or base zero rather than the topping. So the logic of base counting, so a price advances through a series of durations or bases. So as this advance is happening, the transfer of shares is transferred from from stronger to weaker. So the more the bases advance, the weaker the hands are. Diba? So the strongest hand is at your base zero, and the weakest hand is at your topping. So you get the logic that as you advance in base, the more you should be wary of your exposure. So again, the framework. So the elements of let's start with base zero. So base zero usually is near the 200-day EMA. It's also called the reset. Also called neglect if it's below 200 days. This is where profit taking ends in new positions of new players, particularly institutions, insiders. The stronger hands begin accumulating their positions. So there's no timing here essentially. Theoretically, the deeper the correction is, the longer it would take for the reset to complete. So this is a long process of accumulation. Examples visually, it can just stay near. So it begins with, if you look at April 2012, begins with a break of the 50-day, convincing break of the 50-day, down to 200-day and even below 200-day. And then at least a 4 to 6 month duration until it breaks the previous high. That's your base zero. Another example is this one. So the deeper it is, the longer it would take for the stock to recover back its previous highs. I think we see a lot of these resets in our high growth list, in the art list. This one, Amazon in 2014. It's a long period, base zero. So most of the time, so it's really recommended that your resets or base zero, the stocks that you participate during resets or base zero are those that are not as speculative, because you know that um, institutions will be willing to step in at those price levels and not um, like very informed speculative companies that they can even correct up to 90% from the top. So during resets, it's really recommended that you buy those stalwarts. So for advancing bases, for advancing bases, uh, basically bases are mainly coils, shorter durations, so basically coils and ideally coils. Changing of hands are much faster. So you're already pricing in bullish expectations already. These bases stay above the 50-day EMA, normally 4 to 6 weeks. The bases 3 and above are usually displaying divergences. So there's an overlap between these bases and the topping phase. Example, this one, Teladoc 2018. So that's your base zero, a strong base zero, strong reset because it stayed above the 200-day. That's your base one, duration, falling coil on base two, a small duration on base three, and then yeah, you see that divergence when it's stopping in the base. Clear? Another example, later example. Let's go with topping phase first. So for topping, it's simple. Um, price ranges are wide. They show bearish divergences, meaning prices are moving higher, but your MACD is um, experiencing lower highs. If that doesn't happen, you will see either you see divergences or prices break the 50-day EMA convincingly. So that's your topping example is this one. A divergence, bullish divergence in 2018. So that's what you have to see. So this is again the frame. So few more examples. So this is Tesla, base zero, 5 to 6 months of base zero, then your base one. This is your Bitcoin. This base zero is, I think this is a 2-year, 3-year base zero. This is a very, very long base zero. So base one, we experienced last December. Falling coil for base two. In a topping movement, price action, a bearish divergence for your topping. And then complete breakdown of the 50-day EMA. I think this is clear. I think Bitcoin showed a clear full cycle. So what we're seeing now in Bitcoin is it's going, it's doing its reset process. It's going through its neglect period. Another example is ARK Invest Innovation. So from base zero, that's your base one, base two. So this base zero is very long to mga 1 year to 2 years. Short durations for advancing bases, and then your bullish divergence in the break at the 50 for the reset. Clear? Another one for NEO. So it also works, the base counting principle also works for stocks, for individual issues. So that's your base zero in NEO. It's your base one, base two, divergences. So the divergence is clear last January. So another example, S&P. 4 bases. So if you notice the current S&P chart is moving in channels. So really, we couldn't count a simple. We couldn't. The advancing base is that's clear to me for the current S&P is just base one because it's really moving in channels. Bases are really, if you can call it bases, really, really short. So this one, 2017 S&P bases are somewhat clear. So you can go more than 3, 4, 5 bases. But the concept is you know where it came from. The reset was far, far ahead, happened far, far ahead. And there really is a lot of profit taking to be had. That's why black swans will be more common in this area. Another example, for Hong Kong, Meituan, base 3 almost broke down to reset. This is once a we could do a longer base. No divergence was shown, but a clear significant break of the 50-day was shown. So this is your topping. BYD, 2-year base zero. So your base one, some nuances. Your base one can be should be outside ideally of your previous high or near it. So you can count it as your base one or near it. Even if it's inside, you can count it as base one now. So this one's clear. Your topping phase showing bearish divergence and break of the 50-day. Philippines, ASEN, everyone's favorite. Long, how long is this? 9-month base zero. Then suddenly shorter durations for advanced bases. So right now, it's coming out of another base zero. So maybe you can start counting the advanced bases for ASEN once it breaks the previous high of 10. So that's the framework, and that's how you should be able to visualize the concept of base counting and pyramiding. Um, uh, the last part of this lecture for this afternoon is bonus lang tayo, basic analytics. Because this is very important. You really have to write down your results, your outcomes, because there's such a thing as survivorship bias. That's how important an evaluation is. Survivorship bias meaning you only remember the things that are great. You don't really remember the sad things that happen. So really have to, akala mo kumikita ka, but when you write it down, hindi pala. So really have to write down your outcomes. And as a business, you really can't improve your business if you really can't have any semblance of measurement. So there, that's how important it is. I show you a few analytics that you can use. So analytics that we use also in CTS, performance ratios namin. Again, we spend a big part of our coaching trying to figure out strong, uh, our strengths, our A trades. So combination of coaching and combination of coaching and analytics. So coaching, which involves also accountability. So You have to have a partner, as the chairman said, to point you to what's working for you and what's not working. So that combination of a community and analytics really helps a lot in finding our strengths. So a few analytics, simple ones. Win rate, you know this, total win amount over the number of winning trades. So if you made $10,000 out of 10 winning trades, so your win rate is no, sorry. If your number of correct trades over your total trades, di ba? Sorry. Win rate is the total win amount of over your number of win trades. So that's how much you win, how much gain that you make every time you win. So nilito na. So every time you make a winning trade, the win rate is how much you make. Diba? The burn rate is every time you lose, how much you lose every time you make a losing trade. Your hit ratio is your number of win trades over your total number of trades. That's easy. And edge ratio is your win rate over your burn rate. So edge ratio, for example, if your edge ratio is 2 times, that means for every dollar that you trade makes you $2. I think that's as simple as the formula can be explained. I think the other formulas you can practice on your own. If you look at the up chart on the upper right, this chart is made using a 2:1 risk reward ratio and a hit ratio of 30%. So you will see that even if you have a 30% hit ratio, if you only have an edge ratio of 2 times, you're still down 3%. The right number is 2.4 times for a 30% hit ratio. So as a standard, most traders have that kind of number, 30% hit ratio. They make it up with a higher edge ratio. Sometimes they do it at least 2.5, 3 times. The best ones we have 3 to 4 to 5 times edge ratio. So practice tayo. So evaluate this elite trader given 10 outcomes of his trades. So number of winning trades, ilan? Okay, 3. Losing trades, dali lang. Yun yung pinakamadali, 7. Okay. That means a hit ratio of how many? 30% hit ratio. So total win amount. So total win amount meaning add mo lahat ng winners mo. So that's 900. Total loss amount is ilan? 100. So what's your win rate? How much do you win every time you win? Every time you make a winning trade. So every time you make a winning trade, total win amount divided by number of winning trades. So 900 divided by 3, that's 300. What's your burn rate? Ilan sinusunog mo every time you lose? 100. So what's your edge ratio? Your hit ratio is 30% and your edge ratio is 3 times. So even though if you're losing 7 times every 10 trades, is this guy making money pala? Is this guy making money? How much did he make with this 10 trades? 20%. I think you guys get the how it's being computed. I think computation is the easiest portion of this one. Another example. Evaluate this recovering trader. Please help this recovering trader. What should he do first? Hit ratios are the same, really bad, 30% also. Not as bad naman. 30% is standard. What should he improve? Losses are too big. Sabi, expert. May expert dito. Good, 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 good. So if you notice, the elite trader has really almost standardized losses. This one medyo kalat. So the edge ratio is point because losses are too big, it contributed to an edge ratio of 0.5 times, diba? The elite trader a while ago was 3 times edge. This one's 0.5. So what should he do? Quit. Quit na lang. Quit na lang. Yeah. So this is a really good starting point for improving your, um, if ever you're experiencing this, improving your trading because you see it in black and white. It's really objective. Don't analyze this yourself, I think. It's best that you have somebody analyze it for you. Kasi minsan, ano eh. Oh, hindsight. May hindsight dito. Di ba hindsight, Jetro? Siguro with if you evaluate some more the trades that you made, diba? The qualities, the qualities of it, why it, uh, why it's correct, diba? Probably it's really a setup that's for you. So those are the things that you will want to answer. But definitely, edge ratio has to improve. Diba? So one things that's very, very easy to do is to focus on the things that you can control. The reward, di kaya. The reward you can control. So focus on the things first of that you can control. So probably improve on controlling your losses, limiting your losses to a very, very standardized one. Hindi yung minsan 100, minsan 300. Diba? So that's a good starting point for improvement, really. Trying to focus on the things you can control first. So if you control your losses, as what happened to Kalum Jack, diba? Was able to control his losses and things improve. Or maybe this can be your homework na lang. You can do you can do this at home. You're at home, you can do this. So we can proceed to Q&A already. You know? If you have any questions about this, you can ask me. basically you understand how it's already. So you will see here a granular analysis of the trades. So saan ba siya magaling? Momentum, coil, or marami siyang unnecessary trade, di ba? So those are the things that you want to know with your numbers. So there. So to end this lecture, haba pala, no? To end this lecture, so so what we want is outperformance. So we want to push ourselves as traders to outperform. As in your intro, your goal is to make 5 to 20% a month, diba? So the road to outperformance really 3 steps that begins with survival. So first, remove again your big losses, control your losses, focus on the things that you can control, so that you will be able to make those multiple number of trades to give you a chance of having a crack at that very, very good risk reward trading opportunities. You have to survive first. And then after surviving, so you, as we recommended, the things you can do is use a VAR or use a position sizing, use the position sizing principle of constant betting or the VAR system to control your losses. Yeah. And also to control risk or exposure, you can use that. You have to keep in mind that pyramid principle or base counting principle to be able to control your aggressiveness, understanding where you are in the market, where it is prone to selling, diba? Things, or where it is prone to black swan. So you have to keep those in mind. So with all of those things, you want to have an equity curve that's really not following the market when things are collapsing. So after surviving, as you improve your trading, not having that drawdown and wasting your time clawing back to positive, um, you can try to be, you can experience being consistent. Even small returns, just as long as you are consistent with your process. And then after that, that's where you try to scale up, meaning try to, from from learning everything that you need to learn to removing the things that you don't need and focusing on the things that you're strong at. Scaling up means focusing your strengths also, using analytics to scale up your size. It's part of it. And really that's where you'll begin to outperform. So everything begins with survival, which can be done through risk management. So I think that's it. Pagod na kayo. 3 hours pala yun. 2 hours, 3 hours. I think I can answer questions if you still have any. Okay, Erica.
Hi, sir.
Oh,
Yung yung for ano pala, yung base counting, like may tips po ba kayo kung kailan siya i-consider as a base? Kasi minsan nakakalito siya i-count for me. Like may minimum ba na dapat kunyari 1 month yung base bago mo i-consider as a base?
so ideally, base ones are shorter durations. Has to be shorter than your neglect or base zero, diba? Our standard, the ideal coil, ideally it's a coil That's the shorter duration, shorter than the reset. It's basically mga, what, 6 to 8 weeks? Ano ba yung tinuro sa inyo? 6 to 8 weeks? 4 to 8 weeks. But, but you have to keep in mind that it's tighter than the resets, ideally, and prices are staying above the 50-day EMA. That's your baseline. And your MACD is staying above zero. So prices staying above the 50-day, MACD staying above zero, 6 to 8 weeks, that's the ideal one.
I see.
But not
Okay.
necessarily it's always exactly like that, diba? But just try to understand that it's a shorter duration, and essentially it's a weaker hand, and it's discounting the current strong sentiment. So that's it.
Like, as an example, sir, kasi yung mga recent na issue sa US is mukha silang, like, do you consider that a reset or late stage
Reset.
basis? Yung mga recent na, parang ang lawak na nung mga base recently.
Uh, for me, the high growth are resets. The high growth ones experience. The Neo are resets, diba? The Shopify's are resets coming out of base zero. So you'll see the first one out of the resets are the high uh, high growth mid caps.
Yung mga
So
2020 leaders.
yeah. Oh, I think that's the ideal reset trades. Kasi again, those are strong hands participating. Diba? Especially when the reset occurs above the 200-day. That's a strong. That's those are institutions that's are that having strong hands. Talagang you can't really, you will rarely see it in very speculative ones. Rarely, kasi again speculative. What? How many funds really are willing to deploy a lot into very speculative issues, diba? So at the very least, you have to have something that's, kung pwede, making money already, having that model already, so that they'll be willing to put their money above the 200-day, diba? And hold it for longer.
Okay, so
Mahirap kasi,
recent pala
like
siya.
for example, is this space? Space ba yan? Space, diba? Yung Virgin Galactic. So that's a really difficult trade, and I don't expect long-term investors to put their money into that because it's really very speculative. And I expect more volatility. Maybe I'm wrong, diba? Maybe I'm wrong, but the probability of a successful reset for me is should be traded with those mga 2020 yung sinabi mo, Shopify, Amazon,
Cloudflare.
Nvidia, diba? Those things na may business na talaga.
So, sir, given na ano pala, so considered pala sila reset, I was considering them late stage kasi. Like, natatakot ako kasi parang yung index, parang sobrang divergent na. Like,
Yeah,
kaya nakakabahan na talaga ako. Like, so, would
yeah,
you
that's
say
my
na
concern also.
aggressive pa rin at this
That's
environment?
my
Yeah, oh,
that's my concern also. So again, you have those you're trying to balance between risk and reward, diba? Balance risk and reward. So it's really a big difference from this year to last year, and the S&P really needs that major reset. So ako rin it's at the back of my mind yung bearish divergence sa S&P. Um, for me, I'm trying to I'm not as aggressive, so that's at the very least that's my that's one way to manage risk. I'm not as aggressive as I have compared to last year. Um, as long as on a day-to-day basis, pag may setup that I think is valid, yon, I trade it. But if you're still concerned with it, lower your lower your exposure. Again, you have that right now. I think you have that concept of popping face, diba? That's why it's at the back of your mind already, and that's an advantage for you, kasi it may correct or it may not correct, but because you know that kahit papaano parang may risk of this having a major correction, with the use of that concept, you try to lower your risk. Diba? So there will be a difference from your risk taking today and risk taking last year. There has to be a difference, diba? It's not the same. Kasi last year, kaka-start. And this year, parang tail end, diba? Parang somehow, diba? So, yeah, we're not in the predictive business naman eh. So, probabilities-wise, weigh it. You have all those switches that you can adjust already. That's the best you can do.
Sir, could you elaborate personally how you lessen your aggression? Is it like yung total port var nyo, liniitan nyo or something like that?
Yeah, last year. So last year, I have lesser sleep. That's one. Uh, on average, I'll be having 10 positions at a time, 10, 15 positions at a time. Uh, I'm using margin all the time. I'm I'm slower to profit take. Um, and also, there's a glaring difference with the market kasi hindi broad yung galaw. So, last year, if you trade, parang namimigay ng pera yung market. So, that's really a big difference. Really big difference. So, in terms of my aggression, yun, lower everything. I'm currently trading at, on average, lowest VAR per trade. So, for example, the other day, I traded, may nag-recommend dito eh, DLO. So, this IPO, diba? Was talking about the inside day of DLO, inside day. So I saw that somebody liked it in Cloud Arc, one of them. So may inside day, nakita ko yung inside day sa DLO. Even that 0.5 bar and sold half. Actually sold all. And I got $180. So just an example.
Sige, thank you, sir. Kasi right now, sobrang like,
So
natatakot talaga
for example, you have
ako makatrade.
let's say reset trade of what? Let's say CRISPR. Gusto mo yung reset trade ni CRISPR, for example. So, at the back of my mind, S&P might correct, but there are still good setups like CRISPR na reset. If S&P was last year, I might do 2%, 3% VAR to the bottom. But right now, siguro 1% lang. Kasi I'll be sitting on it kasi position, ano siya eh, di ba, reset eh. I'll be sitting on it. So you try to balance the risk eh, and what the market's giving you.
Yeah, thank you so much, sir.
Okay. Naintindihan niyo ba yung lecture?
Guys, questions pa?
Questions?
Ayun, Alvin.
I have to read it.
What's too many stocks to hold at a certain amount?
So it depends on the person. Like me, if you ask me, I can go 6% VAR a night. Poten-
Grabe.
no, no, wait, potential VAR. This is not necessarily I eat that 6%. So I can plan for that. Oh, so we say I can plan for that. Um, what else? 6% a night. That would be at least mga, sige na lang, so yeah, 6 to 10 positions. I can plan for that. Pag na-done lahat, then I'm ready for it. Diba? I know what to do. So you ask me, what should I do pag na-done lahat? Should I say, bahala na din? So the first, hindi naman sabay-sabay madadan yan eh. So usually the first one to go should be the strongest one. So pag nag-gap up, I don't chase prices, I cancel. So what else? If it's not working, my first one or two, three trades, if it's not working, nagbabawas na ako. Yeah. If it's a very, very good market, it should tell you already.
Hi Brian, we actually have some
Yes,
questions from the Facebook live stream. So this first question is from Rika. She's asking, which do you use for determining stops? Fixed percentage, price-based stops, or indicator-based stops? For price-based stops, do you allot a small percentage below support in case of shakeouts?
Which do I price? Which do I what?
Which
Again,
do you
please.
use for determining your stops?
Oh,
Fixed
which do I
percentage,
use?
price-based, or indicator-based?
Indicator base. No, no, I don't use the moving averages. Fixed percentage. Yeah, fixed percentage. What's the other one? Fixed percentage. I actually depend on price action. So, but in computing my VAR, so depends on the setup. Depends on the setup. So I have that. Let's say for a coil, I'll put in 1%, and then depending on real time, if how the price moves, then I have to adjust my risk in real time. Again, guys, you're traders, you know setups. Again, you are trying to allocate trades across setups. So, diba? In a timely manner. So, supposedly, when you enter it, it's very close to perfect timing. Not really man perfect, diba? Just allow that wiggle room. But if I, if you the setups usually when they break out, they have to go already. So I think that's one thing you have to be able to experience. So once you have that experience, so you will be able to adjust your losses. Kasi if dati you don't have that kind of observation in the market, you follow your full stop, di ba? Ngayon, you know how a price behaves properly when it's really about to move. So yeah, I adjust it pre-market. I have computed pre-market and then I adjust it real time using a VAR-based formula.
Okay, thank you for that. I hope that answers your question, Rika. The second question is from Rafael. He's asking, do you recommend sizing down your position size when having a losing streak or your portfolio is down a certain percentage?
Yeah, that's what I do. That's what I do. So well, some wouldn't advise that. Yeah, you have to be consistent because again, you have to be kasi yung treatment mo for every trade should be the same. But I believe in blowing hot and blowing cold kasi. So and again, drawdowns can be produced by consecutive losses. So I want to lessen that agony and regret, shall we say kanina. So as much as I am progressive in risking, in taking risks when I'm blowing hot, when things are doing well, I'm also um, regressive in every time I'm blowing cold, meaning I lower and lower until I reach my minimum VAR, until I reach my minimum VAR of 0.25. Now, I have to see that those 0.25 VAR trades work. I have to see it work before I put it back up to my normal sizing. Mabilis lang eh. It's really, I'm really quick in adjusting up. So I really don't, that's what the reason why I'm lowering my VAR every time I'm blowing cold, because I really don't want to um, dig a bigger hole to get out of. That's really one of the, it really affects me psychologically. It will affect confidence like any other human being that's losing.
Okay, thank you. One last question from the stream. This one is from Miguel. He's asking, in your experience, how do you avoid gambler's fallacy?
Gambler's fallacy meaning, can you remind me, refresh me with that?
Gambler's fallacy is, one second, is, where's this? The irrational belief that prior outcomes in a series of events affect the probability of a future outcome. Even
Okay.
though, yeah.
Parang heat check. Tama ba? Heat check, no? Parang heat check. Well, again, for me, in my experience, if I'm making money, I just try to be aggressive with it. Again, I think I saw in one of your lectures, risk on and risk off. Markets experiencing a risk on and risk off periods of sentiment, diba? And risk on periods last for how many days and weeks and months, diba? So markets really run on streaks, losing and winning streaks. So you have to be able to take advantage of those winning streaks. Now, if you believe in gambler's fallacy, parang what? After the third correct trade, stop ka na, gano'n? Tama ba? So I think you have to still continue until things are doing well. Sentiment is really allowing it for you to do it. And in the same manner, if things are really not doing well, atras ka na. Really tone down. Tama ba? Did I answer that question? Tama ba?
He's on the stream and he can't really answer directly, but Miguel, if you're, please answer na lang whether we answered your question or not. If not, we'll try and get back to you on that. That's all the questions for now. Does anyone want to ask one last before we wrap up the session?
Yeah, tanong na kayo.
Nag-reply na si Miguel. Okay daw.
Tama ba? Okay.
Okay. Okay, let's wrap it there. So, thank you again, Bryan, for your time today. And thank you to everyone for attending the live session, as always. So, remember that, a reminder that we don't have any live session tomorrow. So, take the time to rest or catch up with the lectures or things that you don't understand. Reach out to us, guys. Please, we're always available. We're happy to help. So next session will be on Thursday na, June 24 with Chad Pacheco, who's gonna be teaching us about his general trade process and his trade execution strategies. So please definitely watch out for that. Everybody keep safe. Have a good rest tomorrow, and we look forward to seeing you on Thursday. Thank you, guys.
Thank you.